know, then it turns out the jobs picture is pretty good. You know, the Fed had cover to lower rates because it looked like we were losing jobs in August. Turns out the September numbers were great, Jonas, and they revised the summer numbers.
Frankly, I'm surprised how well the economy is handling what's already a pretty bad situation in the housing market. Whether that'll continue, that's where I think the optimism is too high with investors. But, you know, like you just said, everyone on Wall Street hates the government, thinks they can't do anything, but somehow we magically think this agency, this Federal Reserve, is going to somehow make hundreds of billions of garbage loans go away and control the housing destruction from spreading across the rest of the economy. I think it's too. I think you got to take a little of that risk. It's still there. Stocks are a little high, given that these risks have not gone away just because we think a 50 basis point cut makes them go away.
Danny, would you be buying with the Dow at 14,000?
I'm always buying. You know, the issue for me is I don't have a very short time frame. When I deal with my clients, I'm talking about 5-year and 10-year time frames, so I'm always buying. I think the Dow 5 years from now, 10 years from now is higher than it is now and probably can do better than any fixed income investment out there. I want to address Wayne's point, though, because I think he's exactly right. The politicalization of the Fed is the problem here. Bernanke had no business lowering interest rates for the reason that he did it. You know, if he's looking at monetary policy, that's fine.
Danny, that's why he's the Fed. That's why he's the Fed and you're on a TV show, okay? I mean, everyone loves to, you know, play backseat driver to the Federal Reserve. The question is that how are you going to play this market? I mean, Terry, I don't even follow what the Fed's doing. I follow what the markets are doing, and stocks worldwide have a bid right now.
Yeah,
China,
because the Fed, cut interest rates. Because the Fed cut rates. They cut the discount rate by a full percentage point.
And you need to follow what the Fed is doing. You can't ignore what the Fed is doing. And that directly relates to corporate profits, for crying out loud. If the cost of borrowing goes down by a half a point, that goes directly to the bottom line. That's going to impact corporate profits, and that's going to impact stock prices. You can't ignore what the Fed is doing. Their job is to pull the punch bowl away before the party gets started. The issue here is, has the party started, or are we going into recession? I don't think so.
Okay, Wayne, settle this debate.
Well, I don't think there is selling it. I think Mr. Greenspan lowered interest rates too much and for too long a period of time, and everybody thought he was a genius. He is not. He didn't know any more than this guy knows. And they are pandering to a certain extent to a certain segment of the economy that is going to suffer sooner or later, and they're just putting it off.
Which is the hedge funds and the leverage players in the market.
Always blame the hedge funds. Got to get that in, right, guys?
No. Well, it was Wayne who said it. I was just clarifying it for him. Okay, thanks, everybody. Thanks, Jonathan.